but now it is eighth class. Okay, okay, eighth class now.
Quiet now. Nobody will talk. He'll give in a brief now.
Okay. Good afternoon, friends, and good afternoon, ma'am. Thank you for giving me this opportunity to explain the stock market. So, in 1600s, the Dutch East India Company wanted to extend their trade to the all around the globe. So they employed hundreds of ships so that they can trade their goods around the globe. So as this was expensive and they could not finance it properly, so they approached the private people who could invest money in them, and they promised a part or a share of the profits that respective ship will get. In doing so, they unknowingly invented the world's first stock market. So, what is stock market? Stock market is also known as equity market. It is a market where a stockholder or a shareholder trades the company's stocks or shares. And derivatives. So, what are derivatives? There are so many derivatives. One of them is warranty. Warrant. So, warrant is nothing but a bond between the producer and the consumer, that whatever be the state of the market, the producer should sell his goods to the consumer at the agreed price. And shares represent the part of the profit the company will make after it is sold. So share represent a fraction of ownership in a business. So if a company is shut, then it need to repay these loans and all the money. Uh, so in that, they when the company is shut, the shareholders gets a part of the profit the company makes, and the equity participation is nothing but that the shareholders has all rights to sell or buy the company's stocks. And there are different classes of shares, which are equity shareholders and equity shares and preference shares. So what is the difference between equity shares and preference shares? So equity share, so most of the people prefer preference shares, because in preference share the company assures them a sum of the money, and equity shares, uh, if the company is at loss, then the equity shareholders will not get the money or the part of the profit the company makes. But equity shares can be traded in the share market, and preference shares cannot be traded in the share market, and preference shares cannot can be traded only to the buyer from the company, and equity shares can be traded in the share market. That's why it is called as equity share market. And equity shareholders have the voting rights, like if they want to decide a new owner, so it has a voting rights, and they can participate in the finance of that company. And preference shareholders does not have voting rights, or and they cannot participate in the financing of that company. So who is a shareholder? Shareholder is or nothing but a stockholder is an individual or a company who legally owns one or more shares of a company. Here, company or corporation is nothing but it's a company which the people can invest their shares, and the company buys the shares on the behalf of their members. And why does a company issue shares? Company issues shares so that they can get additional capital. Say if a company A wants a capital of 500 crores to start the company. So there are so many ways it can get that money. That is, one is loan and another is the shares. So if and there are two types of company. One is private and public. private company is nothing but a company owned by a small number of people like friends or family, and public company is nothing but owned by so many members. So it's not a public company is owned by so many members, nothing but shareholders. So if a company want an additional capital, it issues some shares so that it can get that amount. And some companies prefer to in being private because there are chances of incurring a loss by issuing the shares. So if they wanted a sum of 500 crores, then they issue the shares which cost 500. So if they don't get that money, then it's a loss for that company. Uh, so some companies prefer to be in being to stay private, and some companies goes public so that they can receive additional capital to invest in a new project. So and there's also one more method known as underwriting, which is usually done by the investment banks. So that, and it's nothing but an assurance the investment bank gives to that company that there will be no loss in the no loss means let's say company A has issued some shares worth 500 crores, then the and if after issuing in the market, if they only get around a 300 if they only get around 300 crore rupees, then the rest of the 200 crores rupees value shares are directly bought by the investment banks, and they sell it in the right time. So how does a company issue shares? It issues IPO, nothing but initial public offering, to the industrial investments investors or the retail investors. Industrial investors are nothing but the professional investors whose profession is to invest in the stocks, and the retail investors are the non-professional investors who can invest some money in the market. So through IPO, the company issues the shares, and then the investors or retail investors can further trade it in the stock market. And once a company is listed, a company is if a company become listed, then that company will be named as limited. So how can a company like we come across the words like private limited? This means that a company is listed. So how the company is listed? Earlier, it need to acquire some requirements like a share number of shareholders, or the shares held by the shareholders, or the minimum shares hold. So after getting these requirements, a company can be listed. So what is the advantage or purpose of being listed? So if a company is listed, then it can issue shares further with a different reason. Let's say if a company A has issued share first time for to start that company, and after some time, if the company is listed, it can again issue the initial public offering with a reason, say they want to extend that extend their company, or open another branch. So if a company is listed, it can issue shares how much ever it wants, but if they issue a lot of shares, then there will be no demand for the shares, and they can incur a loss. And financing a company to the sale of stock is in a company is known as equity financing. Equity financing, nothing but financing or selling selling of the shares. Trading. The shares of a company are in general be transferred from one shareholders to another. So a shareholder can trade his shares to another shareholders in through share market or stock markets. So this leads to the buying and selling of the shares termed as trading. So we cannot directly buy or sell the shares. There are some middlemen who with the help of them only we can do that, and they are known as brokers. We can trade our shares in the share market only with the help of brokers, and nowadays those brokers being are less because of the introduction of the online equity financing. Nothing but some websites are playing the role of the brokers. So most of so we can go to the website and order it to buy or sell these shares that we own, or we can buy through the internet. But in the olden times it was with the help of the brokers. So buying and selling of the shares is possible only through a stockbroker, and of course the stockbroker will not do it freely. They cost a percentage of what they do. So this is termed as a commission, or you can say it's commission. So and then this commission is known as brokerage, and a person can buy the shares from the share market, but it can buy the IPO also. He can buy if he has or already buy some shares or from that company. So stock market and risk. So sometimes the market seems to react irrationally to economic or financial news. This is because, let's say, this means that the stock market react to every news that goes viral in the public. Like recently, the government last year, due to the pandemic, the last year the government hello ma'am, can you hear me? Hello.
We can hear you. Continue.
Okay, thank you. Some let's say if the government has imposed lockdown, then due to this the shares have been the shares has come the shares price has been come down very irrationally. So and this is actually temporarily, and there are two types of players in the market, that is bull and the bear. Bulls are always positive, that they invest in the stocks when their price is increasing, expecting that the price will increase further. And the bears are known as downtrends because they invest in the stocks when their price is very low, and expect that it will increase. And the increase in the sense is, uh, most of them use the graph that is one with the stocks, and another is the years of the. And this is a list of the stock exchange in the stock markets in the India, or you can say stock exchange. Those are Bombay Stock Exchange, National Stock Exchange, Kolkata Stock Exchange, Metropolitan Stock Exchange, and India International Stock Exchange. Thank you, ma'am, for giving me this opportunity to explain about stock market.